Let's start with the most honest thing anyone has ever said about doubling your money. It's possible. Completely, genuinely, mathematically possible. Not as a fantasy, not as a lottery ticket, not as a late-night infomercial promise delivered by a man in a questionable suit standing in front of a rented Ferrari. Actually possible. For real people with real money, through real mechanisms that have been working reliably for long enough that the evidence is not ambiguous. And it's slower than you want it to be. Those two facts need to exist in the same sentence, because most content about doubling money either delivers the first fact wrapped in so much excitement that the second fact disappears entirely, producing the specific kind of enthusiasm that leads people to make genuinely terrible financial decisions. Or it delivers the second fact so heavily that the first fact gets buried under an avalanche of caution that produces paralysis rather than action. This video is going to give you both facts simultaneously in proportion with the specific mechanisms that make doubling your money real rather than theoretical, and with the honest timeline attached to each mechanism so you can make the specific choice about which approach fits your specific situation, your specific timeline, and your specific risk tolerance. Here's what this video is not going to do. It is not going to tell you about day trading strategies that require you to stare at charts for 6 hours a day. It is not going to recommend cryptocurrency schemes with names that sound like they were generated by someone who has never met an actual currency. It is not going to suggest that you can reliably double your money in 30 days through option strategies that the person describing them has never actually successfully executed. There is a vast ecosystem of content making these promises, and that ecosystem is supported primarily by the consistent failure of its audience to achieve the promised results, which creates the demand for more content explaining the next strategy that will definitely work this time. This video is going to describe the actual, evidence-based, historically documented mechanisms through which people double their money, organized from slowest and safest to fastest and riskiest, with the specific steps required for each, the specific realistic timeline for each, and the specific warnings about each that the enthusiastic version of the same information consistently omits. By the end of this video, you will have a clear, honest, specific answer to the question, how do I double my money? Tailored not to an imaginary average investor, but to the specific real choices that real people with real money and real financial situations actually have. Let's start with the math, because the math is where everything begins and where most people's understanding of doubling money is most importantly incomplete. Chapter 1. The Rule of 72. The most useful math you were never taught in school. Here's the foundational mathematical concept that every single subsequent chapter in this video rests on, the Rule of 72. If you already know this rule, consider this chapter a refresher with specific applications you may not have seen before. If you don't know this rule, consider this chapter the most financially useful 3 minutes of mathematics you'll encounter today. The Rule of 72 is a simple approximation for answering the specific question, how long does it take to double my money at a given interest rate? The answer, divide 72 by the annual rate of return, and the result is approximately the number of years required to double the investment. At 3% annual return, 72 divided by 3 equals 24 years to double. At 6% annual return, 72 divided by 6 equals 12 years to double. At 8% annual return, 72 divided by 8 equals 9 years to double. At 10% annual return, 72 divided by 10 equals 7.2 years to double. At 12% annual return, 72 divided by 12 equals 6 years to double. At 24% annual return, 72 divided by 24 equals 3 years to double. At 36% annual return, 72 divided by 36 equals 2 years to double. At 72% annual return, 72 divided by 72 equals 1 year to double. These numbers are approximately correct. The Rule of 72 is an approximation rather than an exact formula, but they are accurate enough for practical decision-making, and they immediately reveal something important about the doubling question that most people don't fully internalize. What the Rule of 72 actually tells you. Here's what these numbers reveal that makes the Rule of 72 more than a curiosity. The relationship between return rate and doubling time is not linear. It is the relationship between the return rate and the doubling time that determines the practical achievability of doubling your money, and the numbers clarify that relationship in ways that should immediately recalibrate your expectations about what is realistic and what is fantasy. At the historical average return of a diversified stock market portfolio, approximately 7% to 10% per year over long periods, the rule of 72 produces a doubling time of approximately 7 to 10 years. This is real. This is historically documented. This is achievable by any person who invests in a diversified index fund and leaves it alone for the required period. It is not exciting on a social media post. It is also not a promise that collapses the moment someone examines it. At the return rates promised by the more exciting versions of the doubling your money story, the 100% annual return, the I doubled my money in 3 months claim, the rule of 72 reveals immediately that the claimed return is either unsustainable, unreplicable, or both. A strategy that genuinely returned 100% per year compounded would turn $10,000 into approximately $10 billion in 30 years. The fact that the people who claim to have discovered such strategies are not uniformly trillionaires should be the first and most important data point in any assessment of such claims. The rule of 72 applied to the wrong side. Here's the application of the rule of 72 that most financial content never discusses. The specific insight that the rule provides about debt rather than about investments. The rule of 72 works in both directions. The same mathematical relationship that describes how long it takes for your investment to double also describes how long it takes for your debt to double if unpaid. Credit card debt at 22% interest, 72 divided by 22 equals approximately 3.3 years for the debt to double if unpaid. The $10,000 credit card balance becomes $20,000 in 3.3 years without any new spending. The $20,000 becomes $40,000 in another 3.3 years. The debt is doubling faster than most investment strategies can double the money that would otherwise be repaying it. Student loan debt at 7% doubles in approximately 10 years if unpaid. The same timeline as a stock market investment, meaning that carrying student loan debt while investing in the stock market is approximately a break-even proposition before accounting for risk differentials. Mortgage debt at 4% doubles in approximately 18 years, much slower than stock market returns, which is the mathematical justification for the widely given advice to invest rather than aggressively prepay a low-rate mortgage. The rule of 72 applied to debt clarifies the specific hierarchy of financial priorities that precedes any investment strategy. The highest interest debt is doubling faster than any investment can realistically keep pace with, which means eliminating it is the highest return financial action available before any investment discussion is relevant. The compounding frequency adjustment. Here's the refinement of the rule of 72 that matters for specific investment decisions. The role of compounding frequency in the actual doubling time. The rule of 72 assumes annual compounding, interest calculated and added once per year. Many investment vehicles compound more frequently. Savings accounts often compound daily, bond funds compound monthly, dividend-paying stock funds compound quarterly. More frequent compounding produces slightly faster doubling than annual compounding at the same nominal rate. For practical purposes, the difference between annual and daily compounding at typical investment return rates is modest, a few percentage points in total return over a decade. But for savings accounts and high-yield savings products where the nominal rate is the primary variable, understanding compounding frequency is the specific technical detail that makes the difference between accurate comparison and misleading comparison. The practical application: when comparing investment options, always compare after compounding effective annual rates rather than nominal rates. The 5% savings account compounding daily produces a higher effective annual yield than the 5% savings account compounding quarterly. The difference is small but real, and it scales with the amount invested and the time period. Chapter 2. The safest way to double your money, and why nobody talks about it. Here's the approach to doubling your money that has the highest probability of success, the lowest risk of loss, and the least exciting story, and that is, as a direct consequence of those characteristics, the approach that gets the least attention in financial content despite being the most reliably effective one available to most people. Investing consistently in low-cost, diversified index funds over the time period, the rule of 72 requires at historical average market returns, that's it. That's the safest doubling strategy. A 7 to 10 year commitment to consistent investment in an index fund that tracks the total stock market. This approach will double your money approximately 70% to 80% of the time over any given 10-year period based on historical market data. It will not always work in any specific 10-year window. The specific decade from 2000 to 2010, which included two major market crashes, produced essentially zero return for the S&P 500, but it is the specific approach with the best historical risk-adjusted probability of doubling over the relevant time frame, and it is available to literally any person with a brokerage account and the behavioral discipline to not sell when markets decline. Why the market doubles money. The actual mechanism. Here's the specific reason that stock market investment has historically doubled money on the time frame the rule of 72 suggests. The actual economic mechanism, rather than the vague assertion that markets go up over time. Stocks are ownership stakes in businesses. Businesses, on average, grow. They grow because the economy grows, because population growth, technological improvement, productivity improvement, and the relentless human effort to create value in the world produces more output and more profit each year than the year before. Not every year. Recessions, disruptions, and crises produce specific years of decline, but on average, over time, businesses produce more value than they did previously, and the ownership stakes in those businesses increase in value to reflect the increased production. The stock market's historical average return of approximately 7% to 10% per year before inflation adjustment is not a coincidence or a historical artifact. It is the specific financial expression of the underlying growth of the businesses that comprise the market. When you buy an index fund, you are buying a small ownership stake in hundreds or thousands of businesses simultaneously. And those businesses are, in aggregate, growing in value at the historical average rate that the rule of 72 converts into a doubling time. This mechanism is genuinely reliable in a way that specific stock picking, market timing, and most alternative investment strategies are not, because it doesn't require any specific company to succeed, any specific economic event to occur, or any specific prediction to be accurate. It requires only that the aggregate economy continues to produce more value over time than it did previously, which is the one prediction about the future that has the most consistent historical support available. The specific steps: opening the account and setting the strategy. Here's the actual step-by-step process for implementing the safest doubling strategy. The specific actions required to go from "I want to double my money through index fund investing" to "I have an account, a strategy, and automatic contributions running." Step 1. Choose a brokerage. The three major low-cost index fund providers, Vanguard, Fidelity, and Schwab, each offer account opening online in approximately 15 to 20 minutes with no minimum opening balance required for many account types. The specific choice between them is genuinely a minor decision. All three offer low-cost index funds, all three have good customer service, and the difference in expense ratios between comparable funds at the three providers is negligible. Choose one and open the account rather than spending 3 weeks researching which one is marginally superior. Step 2. Choose the account type. For most people, the priority sequence is contribute enough to a 401k to capture the full employer match first. This is an immediate 50% to 100% return on the matched dollars, and no investment strategy available anywhere competes with it. Then fund a Roth IRA to the annual maximum, currently $7,000 per year for most people, with the specific tax-free growth and withdrawal characteristics that make it the most valuable account type available to most individual investors. Then return to the 401k to increase contributions if additional investment capacity exists. Then invest in a taxable brokerage account if retirement account limits have been reached. Step 3. Choose the fund. A single total market index fund, VTSAX at Vanguard, FSKAX at Fidelity, SWTSX at Schwab, provides exposure to thousands of U.S. companies in a single fund. A two-fund approach adds international exposure through a total international index fund. A three-fund approach adds a bond fund for the component of the portfolio that requires more stability than pure equity provides. For most investors who are more than 10 years from needing the money, a simple equity-heavy allocation, 80% to 100% in total market index funds, captures the historical returns that the Rule of 72 uses for the doubling calculation. Step 4. Automate. Set an automatic monthly contribution that transfers on the day after paycheck arrival. The automation removes the behavioral variable, the temptation to skip the contribution when the market is declining, when spending has been higher than expected, or when the contribution just doesn't feel urgent. That is the primary reason most people's actual investment returns fall below the market's historical average. The automatic contribution invests regardless of what the market is doing, which is the specific behavioral feature that produces the consistent compounding that doubling requires. Step 5. Do not check it constantly. Seriously, set the investment review schedule at quarterly for performance review and annually for rebalancing. Between those specific review intervals, resist the urge to monitor the portfolio, because the monitoring during market declines produces the specific anxiety that produces the specific selling at the specific wrong time that converts paper losses into permanent ones and eliminates the compounding that would have produced the doubling. The employer match. The fastest doubling available to most people. Here's the specific investment opportunity that provides the fastest and most reliable doubling available to most employed Americans, and that a significant fraction of those Americans fail to fully exploit. The employer 401k match. The employer match is, in its most common form, a 50% to 100% match on employee contributions up to a specific percentage of salary. The 100% match, $1 of employer contribution for every dollar of employee contribution up to 3% to 6% of salary, is an immediate 100% return on the matched dollars before those dollars have been invested in anything. The $3,000 employee contribution that receives a $3,000 employer match has doubled before the combined $6,000 has been invested for a single day. No investment strategy, no market timing approach, no alternative asset class, and no special opportunity available to ordinary investors comes close to the return profile of the employer 401k match. It is a risk-free, immediate, guaranteed 100% return on the matched dollars, and the only cost of capturing it is the contribution itself, which is money that would otherwise have been available for spending rather than for the investment that doubles it before it is invested. The specific step: if you have an employer-sponsored retirement plan with a match and you are not contributing at least the amount required to capture the full match, this is the single most important financial action available to you, regardless of any other financial consideration. The match dollars that are not captured cannot be recovered. Each year of not capturing the full match is a specific, permanent, calculable financial loss. Chapter 3, The Stock Market Deep Dive, How to Double Money Faster Than Average. Here's the chapter that addresses the specific question that the previous chapter's answer provokes. The question that is sitting in the back of your mind right now, which is some version of, okay, index funds, 7 to 10 years, I get it. But is there a way to do it faster within the stock market without taking on the kind of risk that gets people on Reddit crying about losing their life savings in 3 months? The honest answer is yes, with significant qualifications. There are approaches within the stock market framework that have historically produced returns above the market average and therefore doubling times faster than the 7 to 10 year index fund baseline. And there are specific, important, frequently omitted qualifications about each of those approaches that make the honest assessment considerably more nuanced than the enthusiastic version. The factor investing approach, the evidence-based way to beat average. Here's the first above-average return stock market approach that has genuine academic and empirical support rather than being primarily a marketing claim. Factor investing, specifically the value factor and the small cap factor that academic research has documented as historically producing returns above the market average. Factor investing is based on the specific observation that certain categories of stocks have historically outperformed the broader market over long periods. The two most well-documented factors are the value factor, the historical tendency of stocks that are cheap relative to their fundamental value, measured by metrics like price-to-earnings ratio, to outperform stocks that are expensive relative to their fundamental value, and the small cap factor, the historical tendency of smaller companies to outperform larger companies over long periods. The academic evidence for these factors, primarily from the Fama-French three-factor model and subsequent research, suggests that a portfolio tilted toward value stocks and small-cap stocks has historically outperformed the broad market by 1% to 3% per year. At the higher end of this range, the Rule of 72 suggests a doubling time of approximately 6 years rather than 7 to 10, a meaningful improvement from the simple index fund baseline. The qualifications, factor premiums are not consistent year to year. The value factor experienced a decade of underperformance from approximately 2010 to 2020, during which growth stocks dramatically outperformed value stocks. The small cap premium is real but volatile. Small companies underperform significantly during recessions and credit crunches, which is exactly the period when most investors find underperformance most psychologically difficult to sustain. Factor investing requires the specific behavioral discipline of maintaining the tilt through the extended underperformance periods that any factor experiences, which is harder than it sounds when the broad market is generating 15% per year and the value tilt is producing 8%. The implementation, low-cost factor-tilted index funds are available at all major brokerages. The Avanti's U.S. Small Cap Value ETF, AVUV, and the Dimensional Fund Advisors small cap value funds are widely regarded as well-constructed factor vehicles with reasonable expense ratios. Adding a modest tilt toward these funds, 20% to 30% of the equity allocation, while maintaining the broad market core, is the specific implementation that most financial academics would endorse as the evidence-based version of trying to beat the market. Dividend growth investing, the compounding that compounds the compounding. Here's the second above-average approach within the stock market framework, the dividend growth investing strategy that has produced above-market total returns for a specific subset of investors willing to build and maintain a portfolio of companies with consistently growing dividends. Dividend growth investing is the strategy of investing in companies that have consistently increased their dividend payments over long periods. The S&P 500 Dividend Aristocrats, a list of companies that have increased their dividends for at least 25 consecutive years, is the most commonly referenced universe. These companies, consumer staples, healthcare companies, utilities, financial services companies, have the specific characteristics of businesses that generate reliable, growing cash flows that can sustain and increase dividend payments through economic cycles. The total return case for dividend growth investing, dividend income reinvested compounds alongside price appreciation, producing a total return that has historically been competitive with or slightly above the broad market return with lower volatility. The specific appeal for wealth doublers is the compounding of the reinvested dividend stream. The dividend that is reinvested purchases additional shares that pay additional dividends that are reinvested to purchase additional shares in a compounding cycle that amplifies total return over long periods. The qualifications: dividend growth investing requires more research and more individual security selection than pure index investing, which introduces the specific risk that poor security selection or sector concentration produces worse performance than the index. The dividend aristocrats have historically produced returns competitive with the broad market but not dramatically above it. The doubling timeline acceleration relative to pure index investing is real but modest, typically 1 to 2 years faster rather than dramatically faster. The implementation, the Schwab U.S. Dividend Equity ETF, SCHD, and the Vanguard Dividend Appreciation ETF, VIG, provide diversified exposure to dividend growth stocks through a single fund. The ProShares S&P 500 Dividend Aristocrats ETF, NOBL, provides specific exposure to the Dividend Aristocrats universe, adding a dividend growth component, 30% to 40% of the equity portfolio, while maintaining the broad market core, is the specific implementation that captures the dividend growth premium with manageable security selection risk. Concentrated equity positions, the high-risk, high-reward version. Here's the approach that has produced the most spectacular documented cases of money doubling and the most spectacular documented cases of money halving within the stock market framework: concentrated investing in individual companies. The mathematical reality of concentrated investing is specific and important to understand before the strategy is considered. The broad market index contains thousands of companies. and its return is the market cap weighted average of all their returns. Some of those companies will dramatically outperform the average. Some will dramatically underperform. The index investor captures the average. The concentrated investor who correctly identifies the future outperformers captures something much better than average. The concentrated investor who incorrectly identifies future underperformers captures something much worse. The documented cases of extraordinary wealth doubling through concentrated stock positions are real and inspiring. The person who invested heavily in Amazon in 2001 at its post-crash lows, the person who concentrated in Apple before the iPhone, the person who invested significantly in Nvidia before the AI computing boom made it one of the most valuable companies in the world. These are real people who made real decisions that produced extraordinary returns. The documenting convention that makes these stories misleading. They are presented without the denominator. For every person who concentrated in Amazon at the 2001 low and captured the extraordinary subsequent return, there were multiple people who concentrated in comparable companies that looked equally promising on the available 2001 evidence. That did not produce comparable returns. The person who concentrated in WorldCom in 2001 lost essentially everything. The person who concentrated in Pets.com earlier lost everything faster. The selection bias that makes the Amazon story famous is precisely the selection bias that makes it a poor guide to the actual expected outcome of concentrated investing. The honest assessment: concentrated investing in individual stocks is the stock market approach most capable of producing the fastest doubling and most capable of producing total loss. It is appropriate for a specific investor profile. Someone with genuine expertise in specific sectors, a portfolio large enough to absorb the concentrated position without catastrophic consequence from a total loss, and the behavioral resilience to hold through the volatility that concentration produces. It is not appropriate as a primary strategy for most investors who lack those specific characteristics. The dollar cost averaging acceleration. Here's the specific tactical approach that accelerates the doubling timeline without increasing the risk profile of the underlying investment. The dollar cost averaging strategy applied to market downturns. Dollar cost averaging, investing a fixed amount at regular intervals, regardless of market price, naturally produces better average purchase prices than lump sum investing during volatile market periods, because the fixed dollar amount purchases more shares when prices are low and fewer when prices are high. Over a full market cycle that includes significant declines, dollar cost averaging tends to produce a lower average cost basis than lump sum investing at the start of the period, which accelerates the doubling timeline by improving the entry price. The specific acceleration opportunity within dollar cost averaging, increasing contributions during significant market declines. The investor who maintains their regular monthly contribution during a 30% market decline is already benefiting from dollar cost averaging, buying more shares at lower prices. The investor who also increases contributions during the decline, deploying additional savings or redirecting funds that were designated for non-urgent purposes, amplifies the dollar cost averaging benefit by concentrating purchases at the lowest prices available in the cycle. This is not market timing in the pejorative sense. It is the specific behavioral response to lower prices that the rule of 72 mathematically justifies. The recognition that a 30% market decline means the doubling target is 30% closer than it was before the decline, and that adding to the position at the lower price reduces the remaining required return to double from the new lower price. The implementation: maintain 3 to 6 months of emergency fund in accessible savings, maintain a modest opportunity fund, an additional 1 to 3 months of living expenses in a high-yield savings account specifically designated for deployment during significant market declines of 20% or more. When the decline occurs, deploy the opportunity fund in tranches rather than all at once, continuing to add as the decline deepens rather than attempting to identify the exact bottom. The historically documented outcome: the portfolio that was built with additional contributions during market declines compounds to a significantly higher value over the subsequent recovery than the portfolio that maintained only regular contributions through the decline. Chapter 4. Real estate, the asset class that has doubled more fortunes than any other. Here's the chapter that addresses the investment vehicle that has created more millionaires in the United States than any other single asset class, not because it is the most elegant financial instrument or the one with the most sophisticated analytical framework, but because it combines the specific features that make wealth doubling most practically accessible to ordinary people with ordinary incomes: leverage, cash flow, appreciation, and tax advantages operating simultaneously on a single investment. Real estate is not a passive investment. It is not an index fund you buy and check quarterly. It is a business with tenants, maintenance requirements, financing obligations, and the specific operational demands of being a landlord, which range from the genuinely manageable to the genuinely exhausting depending on the specific property, the specific tenant, and the specific market. The people who describe real estate investment as passive income have either never been a landlord or have reached a scale where they can afford professional property management. And the scale required to justify professional management typically requires having built a real estate portfolio that took years to assemble. With that honest framing established, here is why real estate is on this list and why it deserves its own chapter. When the math works and the execution is competent, real estate has the specific structural features that make doubling the invested capital more accessible than in almost any other investment vehicle. And it does so through mechanisms that compound simultaneously rather than sequentially. The 4 returns of real estate, why it outperforms what it should. Here's the specific feature of real estate investment that makes it analytically unusual compared to other asset classes. It generates 4 separate returns simultaneously from a single investment, and the combination of those 4 returns is what produces the total return that has historically doubled fortunes more reliably than any comparable investment. The first return is cash flow, the monthly income generated by the rental property after all expenses are paid, including the mortgage, property taxes, insurance, and maintenance. A well-purchased rental property in a reasonable market generates a cash-on-cash return, the annual net cash flow divided by the cash invested, of 6% to 12% on the down payment. This is the return that makes real estate feel most like a business rather than an investment. The second return is appreciation, the increase in the property's market value over time. Real estate has historically appreciated at approximately 3% to 5% per year on average across U.S. markets. Those specific markets have dramatically exceeded this average, and specific periods have dramatically underperformed it. The appreciation return is particularly powerful in real estate because it is calculated on the full value of the property rather than on only the cash invested, which brings us to the third return. The third return is leverage, the specific amplification of the equity return that mortgage financing produces. When you invest $50,000 as a down payment on a $200,000 property and the property appreciates 5% in a year, the property value increases by $10,000. That $10,000 appreciation on a $50,000 cash investment is a 20% return on the invested capital, despite the underlying asset only appreciating 5%. The mortgage that financed the other $150,000 of the purchase price has amplified the equity return fourfold. The fourth return is mortgage paydown. The specific increase in equity that occurs as the tenant's rent payments service the mortgage, reducing the loan balance and increasing the owner's equity without any additional cash investment. Each month that the tenant's rent payment covers the mortgage payment, the property owner's equity increases by the principal component of that payment, typically $200 to $600 per month in the early years of a standard amortizing mortgage. The combined effect of all 4 returns, cash flow yield, appreciation, leverage amplification, and mortgage paydown, produces total returns on invested capital that have historically been in the range of 15% to 25% per year for well-executed residential real estate investment. At 15%, the rule of 72 produces a doubling time of approximately 4.8 years. At 20%, it is 3.6 years. The BRRRR strategy, the doubling accelerator. Here's the specific real estate strategy that has produced the most rapid documented doubling of invested capital for the investors who have executed it successfully. The BRRRR strategy, which stands for buy, rehab, rent, refinance, repeat. The BRRRR strategy is a specific acquisition and recycling approach that, when executed correctly, allows the investor to effectively pull most or all of their initial capital out of a property after rehabilitation while retaining the rental income and the appreciation upside, enabling the same capital to be deployed into a second property without requiring additional savings for a second down payment. Here is the specific mechanics of the strategy. The investor purchases a distressed property below market value, typically a property that requires rehabilitation work to reach its highest and best use as a rental. The purchase price is below market value because the property's condition makes it unappealing to conventional home buyers and unfinanceable with conventional mortgages. The investor pays cash or uses a hard money loan to complete the purchase. The investor then rehabilitates the property, repairs, updates, improvements that bring the property to a condition appropriate for rental. The rehabilitation increases the property's value from the distressed purchase price to a higher after-repair value. After the rehabilitation, the property is rented to a tenant, generating rental income. The investor then refinances the property with a conventional mortgage based on the new, higher after-repair value. Because the after-repair value exceeds the total invested capital, purchase price plus rehabilitation cost, the refinancing can return most or all of the original cash investment while leaving a loan balance that is serviced by the rental income. The returned capital is then available for a second BRRRR acquisition. Repeat. The investor has effectively doubled the productive use of their initial capital by recycling it from one income-producing property into two. The specific numerical example: purchase a distressed property for $80,000 cash. Invest $20,000 in rehabilitation. Total invested capital, $100,000. After repair value, $150,000. Refinance at 75% loan to value, $112,500 mortgage proceeds, of which $100,000 repays the initial investment and $12,500 is excess cash returned. The investor now owns a rental property with $37,500 in equity, the 25% that was not financed, and has $100,000 plus $12,500 available for the next acquisition. The original $100,000 has not doubled in value, but it has been recycled. The investor's capital is now generating returns from multiple properties rather than from a single one. The qualifications are specific and important. The BRRRR strategy requires the ability to identify genuinely undervalued distressed properties, a skill that requires either significant market knowledge or reliable professional relationships in the real estate acquisition space. It requires the ability to manage or oversee rehabilitation work competently and within budget, a failure point that has derailed many BRRRR attempts when rehabilitation costs exceeded estimates, and it requires access to financing. The initial purchase typically requires cash or hard money loans, and the refinancing requires a strong enough financial profile to qualify for the conventional mortgage that completes the cycle. The BRRRR strategy is not for the first-time real estate investor. It is the strategy that experienced real estate investors use to scale their portfolios rapidly, and it requires the specific operational competence that only experience provides. The simple rental property, the foundation. Before the sophistication. Here's the starting point for the real estate investor who is not yet ready for BRRRR and who wants the foundational experience of owning rental property before attempting more sophisticated strategies, the simple buy and hold rental property that generates the 4 simultaneous returns described above without the rehabilitation and recycling complexity. The specific steps for the first rental property purchase. Step 1. Identify the target market. The best rental property markets share specific characteristics. Population growth or stability. Avoid shrinking markets. Job market diversification. Avoid single-employer markets. Housing affordability relative to rents, the price-to-rent ratio, and landlord-friendly legal environment. These characteristics are researched through publicly available data, Census Bureau population trends, Bureau of Labor Statistics employment data, local rent surveys. Step 2. Understand the 1% rule as an initial screening criterion. The 1% rule states that a viable rental property should generate monthly rent equal to approximately 1% of the total purchase price. A $150,000 property should generate $1,500 per month in rent. A $200,000 property should generate $2,000 per month. This rule is a screening heuristic rather than a precise analytical tool. It varies significantly by market, but it quickly filters out properties where the rental income is clearly insufficient to service the costs of ownership. Step 3. Run the full cash flow analysis before purchasing. The cash flow analysis is the specific calculation of all income and all expenses to determine whether the property generates positive cash flow after all costs. Income, gross rent, expenses, mortgage principal and interest, property taxes, insurance, vacancy allowance, typically 5% to 8% of gross rent, maintenance allowance, typically 5% to 10% of gross rent, property management if used, typically 8% to 12% of gross rent, and capital expenditure reserve, typically 5% of gross rent for major repairs and replacements. The net cash flow after all expenses is the amount the property contributes to the owner's income each month. The properties that do not produce positive cash flow after this full analysis are not viable rental properties at the purchase price under consideration, regardless of how confident the seller or real estate agent is about future appreciation. Cash flow is the margin of safety in rental property investment. Properties without it depend on appreciation for their return, which makes them speculative rather than investment grade. Step 4. Build the team. The rental property investor needs specific professional relationships before the first purchase. A real estate attorney for entity structuring and lease review, a property-focused CPA for tax optimization, a property manager for the choice between self-management and professional management, and a reliable handyman or contractor network for maintenance. The team is not optional. It is the infrastructure that makes the investment manageable and profitable rather than consuming and stressful. Real estate investment trusts. The passive version with real returns. Here's the real estate investment approach that provides meaningful real estate exposure without any of the operational requirements: no tenants, no toilets, no midnight maintenance calls, through publicly traded real estate investment trusts, or REITs. REITs are companies that own income-producing real estate, apartment complexes, commercial properties, healthcare facilities, data centers, cell towers, and that are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This distribution requirement produces the high dividend yields that characterize REITs, typically 3% to 8% annually, combined with the price appreciation that comes from the underlying real estate value and the business growth. The total return history of REITs, dividends plus price appreciation, has been competitive with or slightly above the broad stock market over long periods, with significantly higher current income yield. The REIT index has historically produced total returns in the range of 10% to 12% per year, producing doubling times in the 6 to 7 year range. The specific advantage of REITs for the real estate doubling strategy is the ability to invest in real estate with any amount of capital, not the $20,000 to $50,000 down payment that direct property investment requires, through the purchase of REIT shares in a standard brokerage account. The Vanguard Real Estate ETF, VNQ, provides diversified REIT exposure across multiple property types through a single fund with a low expense ratio. Chapter 5. The Business Route, the fastest legitimate path to doubling money. Here's the chapter that addresses the doubling path with the highest potential return, the highest variance of outcomes, and the most direct relationship between the quality of the execution and the quality of the result, starting or acquiring a small business as the vehicle for doubling invested capital. The business route to doubling money is not an investment strategy in the conventional sense. It is a business building strategy that produces investment-like returns when it works and produces losses when it doesn't. The difference between the business route and the investment strategies described in previous chapters is the degree to which the outcome depends on the investor's own decisions, skills, and efforts rather than on market forces that the investor cannot control. This difference is both the business route's greatest advantage and its greatest risk. The great advantage, exceptional execution, can produce returns that no passive investment strategy can approach. A business that doubles invested capital in 18 months, then doubles again, then doubles again, is a wealth creation engine that compounds in ways the stock market's 7 to 10 year doubling timeline cannot match. The great risk, poor execution, bad luck, or market conditions outside the business owner's control can produce a total loss of invested capital without any of the diversification protection that passive investment strategies provide. The small business acquisition, the overlooked entry point. Here's the business route to doubling money that most people overlook entirely because their mental model of business ownership is the startup, the idea that requires building from scratch, rather than the acquisition of an existing operating cash flow positive business. Acquiring an existing small business is, for many investors, a more reliable doubling path than starting a business from scratch for a specific and important reason. The acquired business has already solved the hardest problem in business building. It has found customers who pay for its product or service, established operational processes that deliver that product or service reliably, and demonstrated the cash flow that justifies the acquisition price. The buyer is purchasing proven demand rather than betting on unproven demand. Small business acquisitions in the $100,000 to $500,000 price range, the main. Street business acquisition market are typically priced at 2 to 4 times annual seller's discretionary earnings, SDE. A business generating $100,000 per year in owner earnings, priced at 3 times SDE, costs $300,000. The buyer who acquires this business with a $100,000 down payment and a seller-financed or SBA-financed balance of $200,000 is generating approximately $100,000 in annual earnings before debt service on a $100,000 equity investment, a 100% cash-on-cash return before debt service. After debt service on the $200,000 balance at typical rates, the net annual return on the equity investment is 40% to 60%, producing a doubling time of 2 to 3 years on the invested equity. The specific businesses most accessible to first-time acquirers in this price range include service businesses with recurring revenue, lawn care routes, cleaning services, pest control companies that have established customer bases and predictable revenue. Also included are trade businesses with skilled labor components, plumbing, electrical, HVAC, that trade at multiples that reflect the difficulty of finding qualified technical staff, and e-commerce businesses with established SEO and product market fit that trade at multiples reflecting the passive income character of the revenue. The acquisition process for small businesses follows a specific sequence. First, identify target businesses through business brokers, industry networks, or direct outreach to business owners who may be approaching retirement without a succession plan. Second, request and review the financial documents, 3 years of tax returns, profit and loss statements, and bank statements to verify the earnings that justify the acquisition price. Third, complete due diligence on the customer concentration, key person risk, competitive position, and operational dependencies that could affect post-acquisition performance. Fourth, structure the financing. SBA 7A loans can finance up to 90% of a small business acquisition, making the equity requirement as low as 10% of the purchase price. Fifth, negotiate the purchase agreement, including seller training, non-compete clauses, and earn-out provisions that align the seller's incentives with the buyer's success. The online business model, the capital-light doubling engine. Here's the specific business category that has produced the most accessible returns for investors with modest capital in the current environment. The online business model that requires minimal startup capital, is scalable without proportional capital investment, and generates the specific type of passive or semi-passive income that allows the business income to be invested elsewhere as it accumulates. The online business models with the most documented wealth doubling track records in the accessible capital range include content businesses, YouTube channels, newsletters, podcasts that generate advertising and sponsorship revenue from an audience built around specific expertise or interest. The specific capital requirement for these businesses is genuinely minimal. The equipment investment is the primary startup cost, and the revenue model scales with audience size rather than with capital investment. The financial profile of a successful content business, a YouTube channel with 100,000 subscribers generates approximately $3,000 to $8,000 per month in AdSense revenue depending on the niche. Adding sponsorships, affiliate revenue, and digital product sales can multiply this to $15,000 to $50,000 per month for channels with genuine audience engagement. The capital required to reach 100,000 subscribers is primarily time and equipment. The return on the modest capital invested can be extraordinary once the audience reaches monetization scale. The e-commerce business model, selling physical or digital products through Amazon, Shopify, or other platforms, requires more capital than pure content but less than brick-and-mortar retail. The specific capital requirement depends on the product category, the inventory requirements, and the marketing spend, but successful e-commerce businesses in the $50,000 to $200,000 annual revenue range have been built with initial investments of $5,000 to $20,000. The SaaS, software as a service micro business, the small software product that solves a specific problem for a specific audience, requires either technical skills to build or capital to hire development, but generates recurring subscription revenue that is the most valuable type of business revenue because of its predictability and scalability. Micro SaaS businesses in the $5,000 to $30,000 monthly recurring revenue range have been sold for 30 to 60 times monthly revenue, producing exit valuations of $150,000 to $1,800,000 for businesses that were built with modest initial investment. The side income scaling strategy, starting small and compounding. Here's the specific business approach that is most accessible to people with modest initial capital and limited time. The side income business that is started alongside employment income and scaled to the doubling threshold before replacing the employment income or being sold. The side income scaling strategy begins with the identification of a specific skill or knowledge the person possesses that has market value beyond their current employer. Consulting, coaching, freelancing, tutoring, content creation, software development, bookkeeping, marketing, virtually every professional skill has a market for its direct application outside the employment relationship. The financial profile of the scaling strategy is specific and worth understanding. Year 1. The side income generates $10,000 to $30,000. Meaningful supplemental income, but primarily a proof of concept and a learning experience. Year 2, the systems, the client relationships, and the marketing mechanisms are established. Income grows to $30,000 to $80,000. Year 3, the business is sufficiently systematized to consider full-time operation, hiring assistants, or sale. Income potential at this stage for successful side businesses is $80,000 to $200,000 annually. The critical financial decision at Year 3, the accumulated side income, if not consumed in lifestyle expansion, represents the capital available for investment in the index fund strategy, the real estate strategy, or additional business acquisition. The side business that generates $60,000 per year in profit for 3 years has produced $180,000 in investable capital, enough for the down payment on multiple rental properties or the acquisition of a small existing business, from skills and time rather than from saved salary. Chapter 6. The high-risk plays, the truth about options, crypto, and the strategies that can double fast. Here's the chapter that most people watching a video about doubling money have been waiting for, the part that discusses the faster, riskier approaches that the financial media covers most enthusiastically and that most financial advisors describe most cautiously. Options trading, cryptocurrency, speculative growth stocks, angel investing, the strategies that can double money in months rather than years, and that can also produce total loss in the same time frame. This chapter is going to give you the honest assessment of each, the specific mechanics, the documented outcomes, the realistic probability distributions, and the specific conditions under which these approaches are appropriate versus genuinely dangerous. It is not going to tell you that you should never consider these strategies. It is going to tell you exactly what you are accepting when you do. Options trading. The complete honest picture. Here's the complete honest picture of options trading as a money doubling strategy, both the specific mechanism that makes doubling in a short period possible and the specific probability distribution that makes it, for most retail investors, a money-losing strategy over time. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price before a specific date. A call option gives the right to buy. A put option gives the right to sell. The price paid for the option is the premium, the cost of the contract, and the maximum loss on a purchased option is limited to the premium paid. The doubling mechanism in options is the leverage they provide. A call option on a stock that is trading at $100 with a strike price of $105 expiring in 30 days might cost $2. If the stock moves to $110 in 30 days, the option is worth $5, a 150% return on the $2 investment. The same $2,000 invested directly in the stock, which moved from $100 to $110, produces a 10% return. The option produced 15 times the return of the direct stock investment on the same underlying price move. This leverage is the specific feature that makes options appealing as a doubling strategy. The same feature that produced 150% return when the stock moved favorably produces 100% loss, the entire premium lost, when the stock does not move above the strike price by expiration. The option buyer needs the stock to move in the right direction, buy enough, within the specified time period. All three conditions must be met. The failure of any single condition produces complete loss of the premium. The probability distribution of retail options trading outcomes is documented and not encouraging. Studies of retail options trading accounts consistently show that the majority of retail options traders lose money over any period longer than a few months. The specific reasons: the premium includes a time decay component that continuously reduces the value of purchased options regardless of the underlying asset's movement. The implied volatility priced into options premiums typically overstates actual subsequent volatility, which means options are on average expensive relative to their payoff distribution, and the psychological challenges of options trading. The temptation to hold losing positions beyond rational stop-loss levels, the overconfidence that a few early wins produce, and the frequency of trading that generates transaction costs reliably produce outcomes worse than the underlying asset's return. The specific conditions under which options make sense as a component of a wealth doubling strategy: options used for portfolio protection, purchasing put options to hedge significant equity positions during periods of elevated risk, have genuine risk management value that justifies their cost. Options used to generate income through covered call writing, selling call options on stocks already owned, produce additional yield on existing positions with manageable risk. Options used for speculative leverage, the most common retail approach, require specific expertise, specific risk management discipline, and specific position sizing that prevents total account loss from any single trade. The honest position sizing recommendation for speculative options: no more than 5% of investment capital in any single speculative options position. The mathematical justification: a 100% loss on 5% of capital reduces the total portfolio by 5%. A 150% gain on 5% of capital increases the total portfolio by 7.5%. The position sizing that limits catastrophic downside while preserving meaningful upside participation is the specific risk management framework that separates disciplined speculative options use from gambling. Cryptocurrency: the volatility that creates and destroys fortunes. Here's the specific, honest assessment of cryptocurrency as a doubling strategy, an assessment that requires acknowledging both the extraordinary documented cases of rapid wealth creation and the equally extraordinary documented cases of rapid wealth destruction, without selectively presenting either as the representative outcome. Cryptocurrency has produced more rapid documented doublings than any other asset class in recent history. Bitcoin increased from approximately $7,000 in early 2020 to approximately $69,000 in late 2021, a 886% increase in approximately 20 months. Ethereum increased from approximately $130 in early 2020 to approximately $4,800 in late 2021, a 3,592% increase. These are not the cherry-picked outliers. These are the two largest and most established cryptocurrencies, producing returns that no other asset class approached in the same period. Cryptocurrency has also produced more rapid documented wealth destruction than any other mainstream asset class. Bitcoin declined from $69,000 in November 2021 to approximately $16,000 in November 2022, a 77% decline in 12 months. Ethereum declined from $4,800 to approximately $1,000 in the same period, a 79% decline. The FTX exchange collapse in November 2022 produced complete permanent loss of customer funds for millions of investors who held cryptocurrency on the platform. The Terra/Luna ecosystem collapse in May 2022 produced complete permanent loss of approximately $40 billion in market capitalization in approximately 72 hours. The honest probability assessment for cryptocurrency as a doubling strategy requires separating the established assets, Bitcoin, Ethereum, from the broader cryptocurrency ecosystem that includes thousands of projects with dramatically worse risk profiles. Bitcoin and Ethereum have survived multiple 80% plus drawdowns and recovered to new highs. This track record does not guarantee future recovery from similar drawdowns, but it provides more historical evidence of resilience than any other cryptocurrency. An allocation of 5% to 10% of investment capital to Bitcoin and Ethereum, sized specifically to survive an 80% decline without destroying the overall portfolio, provides meaningful participation in any continued appreciation while limiting the downside to a manageable fraction of total wealth. The broader cryptocurrency ecosystem, altcoins, DeFi tokens, meme coins, new projects, has a historical record of largely complete value destruction outside of brief speculative episodes. The specific projects that produced extraordinary returns in 2020 and 2021 that subsequently declined to near zero are too numerous to list and too consistent to ignore. The approach to the broader crypto ecosystem that is consistent with rational doubling strategy is small position sizing, 1% to 2% of investment capital maximum, in specific projects with genuine utility and genuine adoption rather than speculative narratives. Angel investing, the highest risk, highest return asset class. Here's the doubling strategy that has produced the largest absolute returns in modern financial history: the private equity. And angel investing in early stage companies that, at the extreme end, has produced the extraordinary returns associated with investing in Facebook, Google, or Amazon at their earliest stages. Angel investing, providing capital to early-stage private companies in exchange for equity, has the specific return distribution that makes it simultaneously the most exciting and the most mathematically demanding wealth doubling strategy available. The documented return distribution of angel investing, approximately 50% to 70% of angel investments produce total loss. Approximately 20% to 30% produce modest returns ranging from 1 times to 3 times. Approximately 5% to 10% produce strong returns of 3 times to 10 times. And approximately 1% to 2% produce the spectacular returns of 10 times to 1,000 times that make the asset class's average return attractive despite the majority of individual investments producing total loss. The mathematical implication of this distribution to have a high probability of capturing one of the spectacular returns, an angel investor needs a large portfolio of individual investments, ideally 20 to 50 or more, because any individual investment has only a 1% to 2% probability of being in the spectacular return category. A single angel investment has a 50% to 70% probability of total loss, and only a 1% to 2% probability of spectacular return. A portfolio of 50 angel investments has a much higher probability of containing at least one spectacular return that compensates for the many losses. The specific capital requirement for a properly diversified angel investing approach, 50 investments at $5,000 to $25,000 each, is $250,000 to $1,250,000. This makes angel investing as a primary doubling strategy inaccessible to most investors. It makes angel investing as a component of a diversified doubling strategy accessible to investors with substantial capital who can allocate the appropriate fraction without catastrophic consequence from the expected losses. The accessible version of angel investing for investors with less capital, startup investment platforms, AngelList, Republic, WeFunder, Start Engine, that allow investments of $100 to $1,000 in early-stage companies, enabling portfolio construction at dramatically lower total capital requirements. The returns from these platforms have been variable and generally modest compared to direct angel investing, but they provide the diversified exposure to early-stage company returns that direct investing at higher minimums would otherwise require. The speculative position, sizing framework, how to play high risk without losing everything. Here's the framework that applies to all the high-risk doubling strategies in this chapter, the specific position sizing approach that allows meaningful participation in high-return strategies without the catastrophic downside that inappropriate position sizing produces. The framework has a specific structure. Divide the investment portfolio into 3 tiers, with specific allocation limits for each tier. Tier 1, the core portfolio, comprises 70% to 80% of total investment capital and is invested in the safest doubling strategies: index funds, rental property, established businesses. This tier is expected to double in 7 to 10 years and should survive any realistic market disruption without permanent impairment. Tier 2, the enhancement portfolio, comprises 15% to 25% of total investment capital and is invested in the higher return but higher volatility approaches: factor-tilted index funds, dividend growth portfolios, REIT allocation, small business acquisition. This tier is expected to outperform the core portfolio by 2% to 4% annually with higher volatility. Tier 3, the speculative portfolio, comprises 5% to 10% of total investment capital and is invested in the high-risk, high-return approaches: options positions, cryptocurrency, angel investments, concentrated stock positions. This tier is explicitly understood to have significant probability of partial or total loss, and is sized specifically so that total loss of Tier 3 does not materially damage the overall wealth doubling trajectory that Tier 1 and Tier 2 are executing. The tiered framework produces the specific portfolio architecture that maximizes the expected doubling return while limiting the catastrophic downside that inappropriate concentration in Tier 3 strategies produces. The investor who allocates 80% to Tier 1, 15% to Tier 2, and 5% to Tier 3 has built a portfolio that participates in the full range of doubling strategies, from the safest 7 to 10 year index fund approach to the most speculative short-term options positions, without creating the catastrophic downside risk that makes most speculative investors' actual returns worse than the boring index fund they abandoned. Chapter 7. The Tax Optimization Layer: How to Double Money Faster Without Earning More or Risking More. Here's the chapter that addresses the most underutilized doubling accelerator available to every investor, regardless of their specific investment strategy: the specific set of tax optimization practices that increase the after-tax return on any investment without requiring higher pre-tax returns, more risk, or additional capital. Tax optimization is not exciting. It does not have the narrative appeal of a cryptocurrency that returned 1,000% or a real estate deal that tripled invested capital in 3 years. It is the financial equivalent of finding out that your car gets better mileage if you inflate the tires properly, not the story you tell at parties, but the adjustment that costs nothing and persistently improves performance every single mile. The specific magnitude of the tax optimization opportunity is worth quantifying before the specific practices are described, because the magnitude is genuinely large enough to change the doubling timeline in ways that are comparable to meaningfully improving the pre-tax investment return. A portfolio generating 8% annual pre-tax return in a fully taxable account, with dividends and capital gains taxed annually at a combined effective rate of 25%, generates an after-tax return of approximately 6%, producing a doubling time of 12 years. The same portfolio generating 8% annual pre-tax return in a fully tax-advantaged account, a Roth IRA or 401k, generates an after-tax return of 8%, producing a doubling time of 9 years. The tax optimization alone, moving the same investment from a taxable to a tax-advantaged account, reduces the doubling time by 3 years without changing the investment, the risk, or the capital. Over a 30-year investment period, the difference between 6% after tax and 8% after tax on a $100,000 investment is the difference between approximately $574,000 and $1,006,000. The tax optimization of account type alone produces $432,000 in additional wealth from the same $100,000 investment, from the same investment strategy, the same risk level, and the same investor behavior. The account hierarchy. The specific tax advantage sequence. Here's the specific sequence of account types that optimizes after-tax wealth accumulation. The priority order that produces the highest after-tax return from any given level of investment contribution. Priority 1. The employer 401k match. As described in Chapter 2, this is an immediate 50% to 100% return before investment. Capturing the full employer match is the non-negotiable first action in any tax optimization strategy. Priority 2. The Health Savings Account, HSA. The HSA is the only triple tax advantaged account in the U.S. tax code. Contributions are tax deductible, growth is tax-free, and qualified withdrawals are tax-free. For eligible individuals with high deductible health plans, the HSA is the most tax-efficient investment account available anywhere. The contribution limit as of recent tax years is $4,150 for individual coverage and $8,300 for family coverage. The specific strategy: contribute the maximum to the HSA, invest the HSA balance in low-cost index funds rather than leaving it in cash, and pay current medical expenses out of pocket if possible, allowing the HSA balance to compound tax-free for decades and then be withdrawn tax-free for qualified medical expenses in retirement or after age 65 for any purpose. Priority 3. The Roth IRA. The Roth IRA's tax-free growth and tax-free qualified withdrawal characteristics make it the most valuable account type for long-term wealth accumulation for most investors. The contribution limit is $7,000 per year for most investors under 50, with income phase-out limits applying for higher earners. The Roth IRA is specifically valuable for young investors and high-growth investments, the tax-free compounding on investments that double multiple times over decades. Produces the largest absolute tax savings in this account type. Priority 4. The traditional 401k beyond the match. Contributions beyond the match capture the immediate tax deduction on the contribution, reducing current taxable income by the contribution amount, and defer taxation on growth until withdrawal. For investors in high current tax brackets who expect lower tax rates in retirement, the traditional 401k produces better after-tax outcomes than the Roth equivalent. Priority 5. The taxable brokerage account, optimized for tax efficiency through the specific practices described below. Tax loss harvesting, the free return. Here's the specific tax optimization practice within the taxable brokerage account that produces the most significant after-tax return improvement for investors with meaningful taxable investment portfolios. Tax loss harvesting. Tax loss harvesting is the practice of selling investments that have declined below their purchase price, realizing the capital loss, and immediately reinvesting the proceeds in a similar but not identical investment, maintaining market exposure while capturing the tax benefit of the realized loss. The realized loss can offset realized capital gains elsewhere in the portfolio, reducing the current year's capital gains tax liability. The specific mechanics: the investor holds a total U.S. market index fund that has declined 15% from its purchase price. The investor sells the fund, realizing the capital loss. Immediately after the sale, the investor purchases a different but highly correlated index fund, a different total market index fund, or a combination of large cap and small cap index funds that together approximate the sold fund's characteristics to maintain market exposure. The IRS wash sale rule prohibits repurchasing the same or substantially identical security within 30 days of the sale, which is why the replacement purchase must be a different but similar fund. The realized capital loss is used to offset realized capital gains in the same tax year, reducing the tax bill dollar for dollar on the offset amount. Losses that exceed current year gains can be carried forward indefinitely to offset future gains. The net effect is the deferral of tax on investment returns. The tax is not eliminated, but it is deferred to a future date when the replacement investment is eventually sold, which is the specific benefit that accelerates the doubling timeline by leaving more capital invested and compounding in the interim. Asset location. Putting the right investments in the right accounts. Here's the tax optimization practice that produces the most persistent after-tax return improvement for investors with both tax-advantaged and taxable accounts, the deliberate placement of different asset types in the account structures that minimize their specific tax costs. The principle of asset location is that different types of investment returns have different tax characteristics, and matching each investment type to the account structure that minimizes its specific tax cost produces better after-tax returns than placing investments randomly across account types. High-tax investments, bonds that generate ordinary income taxed at higher rates, REITs that generate dividends taxed as ordinary income, actively traded funds that generate short-term capital gains, belong in tax-advantaged accounts where their income is sheltered from current taxation. The bond allocation, the REIT allocation, and any actively managed funds should live in the 401k or IRA, where their income generates no current tax liability. Low-tax investments, total market index funds that generate primarily long-term capital gains taxed at preferential rates, growth stocks with minimal dividend yield, belong in taxable accounts where their tax efficiency means they generate minimal current tax liability anyway. The total market index fund in a taxable account generates primarily appreciation that is not taxed until the investment is sold, making it highly tax efficient despite being in a taxable account. The specific after-tax return improvement from proper asset location is estimated at 0.5% to 1.5% per year, not dramatic in any single year, but significant in compound terms over decades. The Roth conversion ladder, the advanced tax optimization. Here's the advanced tax optimization strategy that is most applicable to investors who are approaching financial independence or who have large traditional IRA or 401k balances. The Roth conversion ladder that systematically converts traditional account balances to Roth in low-income years to minimize the lifetime tax cost of the accumulated wealth. The Roth conversion ladder works by converting traditional IRA or 401k balances to Roth in years when the investor's marginal tax rate is below the expected rate at which traditional withdrawals would be taxed in the future. For the financial independence investor who has left employment and is living on taxable account distributions while traditional balances compound untouched, the years of low employment income before traditional account distributions are required create specific windows where Roth conversions can be executed at low marginal rates. The specific math, converting $50,000 per year from traditional to Roth during a 10-year period when the investor's marginal rate is 12%, costs $6,000 per year in taxes on the conversion, $60,000 total over the decade. The same $50,000 per year left in the traditional account and withdrawn at a 22% marginal rate in a higher income period costs $11,000 per year in taxes, $110,000 for the same $500,000 of withdrawals. The tax savings from the latter strategy, $50,000 over the decade, plus the additional compounding on the tax-deferred balance during the conversion period. Chapter 8. The Debt Weaponization Strategy, Turning the Rule of 72's Dark Side into a Doubling Tool. Here's the chapter that revisits the Rule of 72's application to debt, introduced in Chapter 1, and develops it into the specific actionable framework for using debt elimination as an accelerant of the wealth doubling process rather than as an obstacle to it. The specific insight that converts debt elimination from a conservative financial behavior into an aggressive wealth-building strategy is the specific recognition that paying off high-interest debt is the same thing as earning that interest rate on the paid-off balance. Guaranteed, risk-free, immediate. The person who pays off $10,000 of credit card debt at 22% interest has produced the equivalent of a 22% guaranteed risk-free investment return. No investment vehicle available to ordinary investors produces comparable guaranteed returns. The debt avalanche and its doubling math. Here's the specific debt elimination strategy, the debt avalanche, that maximizes the mathematical return on debt elimination by prioritizing the highest interest debt regardless of balance size. The debt avalanche sequences debt payments by interest rate, highest to lowest. Minimum payments are made on all debts, while every available dollar of additional payment capacity goes toward the highest interest debt. When the highest interest debt is eliminated, its monthly payment is added to the next highest interest debt's payment, creating an avalanche of growing payments that progressively eliminates each debt faster than the previous one. The mathematical return on the debt avalanche is the weighted average interest rate of the eliminated debt, risk-free and guaranteed. For the household carrying a combination of credit card debt at 22%, a personal loan at 15%, a car loan at 8%, and student loans at 6%, the debt avalanche produces returns on the payoff dollars of 22%, 15%, 8%, and 6% respectively, declining as the highest rate debts are eliminated first. The specific doubling. Math. $500 per month applied to a $15,000 credit card balance at 22% interest eliminates the debt in approximately 36 months. The $500 per month that was debt service is then available for investment, contributing to the 7 to 10 year doubling timeline from the investment side. The combined effect of eliminating the guaranteed wealth destruction of the 22% interest and redirecting the freed cash flow to investment is the doubling acceleration that no investment strategy can replicate because it captures both the guaranteed return of debt elimination and the expected return of investment simultaneously. The mortgage decision. The most contested doubling question. Here's the specific financial question that produces the most genuine disagreement among financially sophisticated people. The question of whether to aggressively pay down a mortgage or invest the would-be pay-down dollars in equities. The mathematical answer depends on the specific mortgage rate relative to the expected investment return. At a 3% mortgage rate, the expected 7% to 10% equity return makes investing clearly superior mathematically. The spread between the investment return and the debt cost is 4% to 7%, and the investment dollars compound faster than the debt elimination saves. At a 7% mortgage rate, the spread narrows to 0% to 3%, making the comparison much closer and introducing the risk consideration, the guaranteed 7% return of mortgage paydown versus the uncertain expected 7% to 10% return of equity investment. The specific doubling implication. For mortgages above 6%, the guaranteed return of paydown is competitive enough with the expected investment return that a hybrid approach, maintaining index fund contributions for long-term doubling while making modest additional mortgage principal payments, is both mathematically and psychologically reasonable. For mortgages below 4%, the mathematical case for investing rather than prepaying is clear enough that aggressive investment over mortgage prepayment is the wealth-doubling optimizing choice. The psychological consideration that pure mathematics omits. The paid-off house provides a specific and valuable financial resilience, the elimination of the largest monthly obligation. That has a real option value in the event of income disruption. The household with no mortgage can survive on dramatically lower monthly income than the household with a mortgage payment. This resilience has a value that the mathematical comparison of interest rates does not fully capture, and it is a legitimate factor in the decision for households that weight financial resilience highly. Chapter 9. The Income Doubling Foundation. Why doubling earnings doubles everything faster. Here's the chapter that addresses the most direct and most frequently overlooked doubling accelerator. Not doubling the return on invested capital, but doubling the income that funds the investment in the first place. Because here's the mathematical reality that investment-focused doubling content consistently underemphasizes. At the savings rates that most people can sustain, the investment portfolio is in its early years primarily driven by contributions rather than by compound returns. Doubling the contribution is therefore the most direct way to double the trajectory in those early years. The specific math: an investor with $50,000 already invested, contributing $1,000 per month at 8% annual return, reaches $200,000 in approximately 8.5 years. The same investor contributing $2,000 per month, double the contribution, reaches $200,000 in approximately 5.5 years. 3 years of time savings from doubling the contribution, at a stage when compound growth is not yet the dominant factor. The income doubling is not only about the early years, it has compound benefits that extend through the full accumulation period. Higher income invested at a consistent savings rate produces a higher investment balance every year, which generates higher absolute compound returns every year, which accelerates the doubling timeline throughout the accumulation period. The negotiation, the fastest legal way to increase income. Here's the income increasing action with the highest return on time invested, the salary negotiation that costs 30 minutes of preparation and produces an income increase that compounds for the remainder of the career. The documented evidence on salary negotiation is consistently striking. The majority of employed people have never negotiated their salary at any point in their career, and the majority of employers have budget for a negotiated increase above their initial offer. The expected value calculation of initiating a salary negotiation, accounting for the probability of success, the typical magnitude of increase achieved, and the career-long compounding of the higher base, is positive for essentially every employed person who hasn't recently negotiated. The specific doubling connection, a $10,000 annual salary increase invested in full at 7% annual return for 20 years, produces approximately $410,000 in additional portfolio value. A single 30-minute negotiation conversation produces $410,000 in additional wealth over 20 years when the increase is fully invested. No investment strategy produces comparable return on time invested. The negotiation framework that produces the highest success rate. Research the market compensation for the specific role and specific experience level using Glassdoor, levels.fyi for technology roles, the Bureau of Labor Statistics Occupational Employment Statistics, and direct conversations with peers. Document the specific value delivered in the current role, revenue generated, costs reduced, projects completed, measurable outcomes produced. Present the market data and the value documentation simultaneously, framing the request as alignment with market compensation. Rather than as a personal ask, request a specific number rather than a range. The research consistently shows that specific requests produce larger increases than range requests. The career capital investment, building the skills that command premium compensation. Here's the income doubling strategy with the longest time horizon and the most durable results. The deliberate investment in developing the specific skills and capabilities that command premium compensation in the current and near future job market. The specific skill categories that command the largest compensation premiums in the current market are worth identifying explicitly because generic advice about developing skills without the specific market context is not actionable enough to produce the income growth that accelerates doubling. Data science and machine learning. The ability to extract and communicate insights from large data sets is one of the most universally demanded and most undersupplied technical skills across virtually every industry. The compensation premium for genuine data science capability over general analytical work is 40% to 100% in most markets. AI implementation and prompt engineering, the practical ability to implement AI tools in business processes, build AI-powered workflows, and extract genuine productivity from AI systems is a skill that is in extremely high current demand and that is not yet widely developed in most professional populations. The window for premium compensation from this skill set is time-sensitive, but currently significant. Software engineering with cloud infrastructure. The combination of software development capability with cloud platform expertise represents a sustained compensation premium that has persisted for a decade and shows no signs of narrowing as cloud infrastructure continues to grow as the foundation of virtually every business operation. Financial modeling and corporate finance. The ability to build sophisticated financial models, evaluate business performance, and support capital allocation decisions commands premium compensation across investment banking, private equity, corporate finance, and strategic consulting, sales and business development. The specific ability to generate revenue, to identify prospects, build relationships, propose solutions, and close transactions is the most directly compensated skill in the business world. Top-performing sales professionals in most industries earn compensation that is multiples of the average employee compensation at the same company. The income ceiling on genuine sales capability is higher than almost any other skill category. The side income acceleration, the second engine. Here's the income doubling strategy that doesn't require negotiating with an employer or changing career direction. The development of income sources outside the primary employment relationship that add directly to the investment contribution, without requiring any change to the existing career. The specific side income opportunities with the highest return on initial time investment for people with professional skills include consulting and freelancing, providing services to clients directly rather than through an employer at rates that reflect the full market value of the service rather than the employment discount. The professional earning $80,000 per year as an employee in a specialized field can often generate $100 to $250 per hour as an independent consultant in the same field, a rate that would produce $80,000 per year from only 400 to 800 hours of work, compared to the 2,080 hours required to produce the same income in the employment relationship. The implementation sequence. Identify the specific service that can be extracted from the employment context and provided independently. Identify the specific client population that would benefit from that service and has the budget to pay for it. Develop the initial client through the existing professional network, former colleagues, professional associations, conference relationships, rather than through cold outreach. Establish the service delivery, the pricing, and the invoicing infrastructure. Build the client base gradually while maintaining the employment income as the financial foundation. The compounding income effect, the side income that is fully invested rather than consumed in lifestyle expansion, is both a direct contribution to the investment portfolio and an indirect accelerant, because the growing investment balance generates growing compound returns that eventually dwarf the side income itself. Chapter 10. The behavioral layer. The psychology that makes or breaks every doubling strategy. Here's the chapter that addresses the most consistently underestimated variable in every doubling strategy. The specific psychological behaviors that determine whether a mathematically sound strategy produces its expected outcome or produces the significantly worse outcome that the average investor's actual returns reflect. The gap between market returns and average investor returns is one of the most thoroughly documented findings in investment research. Dalbar's annual quantitative analysis of investor behavior consistently shows that the average equity mutual fund investor earns returns 2% to 4% below the funds they are invested in, because they buy after the market has risen, paying high prices, and sell after the market has fallen, locking in losses. Over a 20-year period, this behavioral gap converts what should be a 7% return into a 3% to 5% return, changing the doubling time from 10 years to 14 to 24 years from the identical investment. The behavioral layer is not a soft, optional add-on to the financial strategy. It is the specific determinant of whether the strategy produces the expected outcome or the significantly worse behavioral outcome that the typical investor's psychology produces. The 4 behavioral failures that destroy doubling timelines. Here's the specific catalog of behavioral failures that most consistently convert sound doubling strategies into disappointing actual outcomes. The 4 mistakes that the investment research identifies as most costly and most common. Behavioral failure. 1. Selling during market declines. The most expensive and most common behavioral mistake is selling equity investments during significant market declines, converting paper losses into permanent losses and eliminating the recovery that follows every historical market decline. The investor who sold in March 2020 when the market declined 34% and waited for stability before reinvesting missed the 70% recovery from the lows that occurred in the subsequent 18 months. The paper loss became a permanent loss, and the recovery generated gains for everyone except the investor who sold at the bottom. The specific psychological mechanism that produces this behavior, loss aversion, the well-documented human tendency to feel losses approximately twice as intensely as equivalent gains. A 20% portfolio decline produces an emotional response roughly equivalent to a 40% gain would produce in the positive direction, which means the pain of the decline is more than sufficient to override the rational knowledge that staying invested is the financially correct response. The prevention, the investment policy statement, a written document created before any market decline occurs that specifies the investor's response to market declines of specific magnitudes. The statement commits to specific actions before the emotional state of an actual decline makes rational commitment difficult. If the market declines 20%, I will not sell and will increase contributions by 10%. The pre-commitment changes the behavioral dynamic by removing the in-the-moment decision that loss aversion corrupts. Behavioral failure 2. Chasing. Performance. The systematic tendency to invest in asset classes and funds that have recently performed well and to exit asset classes and funds that have recently performed poorly produces the specific buy high sell low pattern that generates the behavioral gap. The investor who moved money into technology funds in 2000 after 3 years of extraordinary returns and moved money into real estate in 2006 after 5 years of extraordinary returns experienced both cases of buying at the peak before significant declines. The prevention, the asset allocation commitment maintained through rebalancing that systematically sells the outperforming assets and buys the underperforming ones on a schedule. The opposite of the performance-chasing instinct. Rebalancing to target allocation once per year is the specific behavioral discipline that produces buy low, sell high behavior through the mechanical application of a rule rather than through the application of judgment that performance-chasing corrupts. Behavioral failure 3. Complexity addiction. The tendency to continuously modify the investment strategy, adding new funds, removing underperforming ones, responding to new information about attractive opportunities that produces a portfolio of constantly shifting positions and generates transaction costs, tax inefficiency, and the specific cognitive load that makes the strategy harder to maintain consistently. The research is clear. Simpler portfolios maintained consistently outperform complex portfolios that are frequently modified because simplicity enables consistency and consistency enables compounding. The 3-fund portfolio maintained for 20 years without modification outperforms the sophisticated multi-factor portfolio that is continuously optimized based on market conditions. The prevention, the explicit commitment to portfolio simplicity, 3 to 5 funds maximum, and the specific decision framework that makes modification decisions require a predetermined high bar of justification rather than the default response to new information. Behavioral failure. 4. Overconfidence after early success. The specific psychological response to early investment success that produces the confidence to take larger positions, use more leverage, and move toward more speculative strategies. Exactly when the early success may be more attributable to a favorable market environment than to superior investment judgment. The research on overconfidence in investing is consistent. Investors who experience early success in speculative strategies, cryptocurrency trading, options, concentrated stock positions, systematically overestimate the contribution of their judgment relative to luck, leading to larger position sizes that eventually produce larger losses when the favorable conditions that enabled the early success reverse. The prevention, the explicit tracking of investment decisions in a decision journal, a written record of every significant investment decision, including the reasoning at the time, that provides the honest retrospective analysis needed to distinguish genuine investment insight from favorable market conditions that any strategy would have benefited from. The automation infrastructure, the system that makes good behavior default. Here's the specific practical response to the behavioral failure catalog, the automation infrastructure that makes the financially correct behaviors the default behaviors, removing the willpower and judgment requirements that behavioral failures exploit. Automate the contribution. Set the monthly investment contribution to transfer automatically on the day after paycheck arrival. The automation removes the in-the-moment decision that cash availability and competing spending pressures would corrupt. The contribution happens regardless of market conditions, regardless of recent performance, regardless of whether investing feels right on that particular day. Automate the rebalancing. Set a calendar reminder for annual rebalancing and execute it mechanically. Sell the overweight asset classes back to target allocation and buy the underweight ones, without reference to recent performance, current market news, or expert commentary about whether now is the right time to buy or sell specific asset classes. Automate the emergency fund replenishment. If the emergency fund is drawn upon for a genuine emergency, set an automatic monthly transfer that replenishes it on a specific timeline, preventing the permanent depletion of the financial buffer that the emergency fund provides. Remove friction from the right behaviors and add friction to the wrong ones. Make the investment account more difficult to access than the spending account. The investment account should require deliberate action to transfer money out rather than offering the one-click withdrawal that makes impulsive liquidation easy. Make the speculative trading account separate from the primary investment account. The physical and digital separation of the speculative position from the core portfolio prevents the emotional spillover that a single declining speculative position can create in the overall portfolio management. Chapter 11. The Timeline Reality Check. Honest projections for every doubling strategy. Here's the chapter that provides the honest, specific, calculable timeline for each doubling strategy described in this video, the clear-eyed assessment of how long each approach actually takes, under realistic rather than optimistic assumptions, for different starting capital amounts and different contribution levels. Because here's the truth about doubling timelines that the enthusiastic framing of most doubling money content obscures. The timeline depends not only on the return rate, but on the relationship between the starting balance and the ongoing contribution, and at most people's starting capital levels, the contribution is the dominant variable in the early years regardless of the return rate. The honest timeline table. Every strategy, every starting point here is the specific calculated doubling timeline for each strategy across different starting capital amounts and contribution levels using conservative return assumptions rather than historical best-case scenarios. Index fund investing at 7% annual return, $10,000 starting balance, $500 monthly contribution, reaches $20,000 in approximately 18 months. The doubling of the initial balance happens quickly because the contributions are large relative to the starting balance, reaches $100,000 in approximately 10 years. The first $100,000 is the hardest accumulation milestone because compound growth is not yet the dominant factor. Index fund investing at 7% annual return, $50,000 starting balance, $1,000 monthly contribution, reaches $100,000 in approximately 3.5 years, reaches $200,000 in approximately 7 years. The doubling of the starting balance happens in approximately 6 years, close to the rule of 72 prediction, because the starting balance is large enough relative to contributions that compound growth is already a meaningful factor. Index fund investing at 7% annual return, $200,000 starting balance, $2,000 monthly contribution, reaches $400,000 in approximately 7 years. The rule of 72 prediction is accurate at this starting balance level because the compound return on $200,000, $14,000 per year, is significant relative to the annual contribution, $24,000. Each subsequent doubling from $400,000 to $800,000 takes progressively less time as compound growth becomes increasingly dominant over contributions. Real estate BRRRR strategy at 20% annual return on invested equity doubles the initial equity investment in approximately 3.6 years under ideal execution conditions. The qualification is important. BRRRR execution rarely matches ideal modeling, and the realistic timeline accounting for execution friction is 4 to 6 years for the first doubling with high variance depending on deal quality and market conditions. Small business acquisition at 40% annual return on equity, from the example in Chapter 5, doubles the initial equity investment in approximately 1.8 years under the modeled scenario. The qualification is significant. Business acquisition return modeling is notoriously optimistic, and actual returns vary enormously based on execution quality, market conditions, and factors that due diligence does not fully reveal. Options trading. The honest doubling timeline under realistic conditions for retail options traders is not a timeline. It is a probability distribution with a significant probability mass at total loss. The subset of retail options traders who double their options trading capital in under 1 year is approximately 10% to 20% of those who attempt the strategy. The subset who lose more than half their options trading capital in the same period is approximately 40% to 60%. The subset who eventually lose most or all of their options trading capital over a multi-year period is the majority of retail options traders. The starting capital effect. Why the first $10,000 takes longest. Here's the specific mathematical phenomenon that most discourages new investors, and that understanding prevents the specific reason that the first doubling from $0 to the first significant milestone takes proportionally longer than every subsequent doubling. The first $10,000 accumulation, for an investor starting from zero with $500 per month in contributions and no investment returns takes 20 months of pure saving. The same $500 per month contributed to an index fund generating 7% annual returns takes approximately 18 months to accumulate $10,000, a modest improvement from investment returns at this balance level because the investment balance is too small for compound returns to be a significant factor. The progression from $10,000 to $100,000, the first major investment milestone, takes approximately 9 to 11 years for the investor contributing $500 per month to an index fund returning 7%. This is the most discouraging phase of the wealth building journey because the compound growth is real but small in absolute terms, and the goal seems perpetually distant. The progression from $100,000 to $200,000 takes approximately 5 years for the same investor, from $200,000 to $400,000, approximately 7 years with contributions, 4.5 years without, from $400,000 to $800,000, approximately 8 years with contributions, 4.5 years without. The compound growth is accelerating in absolute terms. Each doubling from a larger base generates more dollars per year, even as the doubling time in years remains roughly constant. The specific motivational insight from this analysis: the investor who feels that progress is too slow in the early years is experiencing the mathematically expected difficulty of the early accumulation phase. The compound growth that will eventually dominate the portfolio, generating more wealth per year than contributions add, is building in the background. The breakthrough is coming. The patience required to reach it is the specific behavioral challenge of the early years, and understanding that the difficulty is normal and temporary is the most effective antidote to the discouragement that makes people abandon the strategy before the compound growth becomes visible. The savings rate multiplier effect. Here's the timeline variable that most dramatically affects the doubling timeline at any given return rate: the savings rate, which determines both how fast the portfolio is being built through contributions and how small the financial independence target is, because the spending it needs to support is lower. The investor saving 10% of a $100,000 salary, $10,000 per year, and investing at 7% reaches financial independence in approximately 43 years from a zero starting balance. The investor saving 50% of the same $100,000 salary, $50,000 per year, reaches financial independence in approximately 17 years. The investor saving 70%, $70,000 per year, reaches financial independence in approximately 9 years. The specific mechanism that accelerates the timeline so dramatically at higher savings rates, the financial independence target, is determined by annual expenses, not income. The investor spending $50,000 per year needs a portfolio of approximately $1,250,000 to be financially independent. The investor spending $30,000 per year needs approximately $750,000. The higher savings rate both increases the contribution to the portfolio and reduces the financial independence target simultaneously, both effects pushing the timeline in the same direction. Chapter 12. The complete step-by-step plan. Your personalized doubling roadmap. Here's the chapter that assembles everything in this video into the specific, actionable, step-by-step plan for your personal doubling strategy, organized not as a single prescription, but as a branching decision framework that produces the specific appropriate strategy based on your specific starting point, your specific timeline, and your specific risk tolerance. Step 1. The financial foundation audit. Before any doubling strategy is implemented, the honest assessment of the current financial position is required. The specific audit items: emergency fund status. Is there 3 to 6 months of essential living expenses in an accessible, liquid account? If not, building this fund is the first priority. Not because it accelerates the doubling directly, but because the absence of an emergency fund creates the specific scenario where investment positions must be liquidated at the worst possible time to cover unexpected expenses. High interest debt status. Is there any consumer debt above 8% interest? If yes, the debt avalanche toward complete elimination of this debt is the highest return action available and takes priority over investment beyond the employer match. Every dollar of high-interest debt eliminated is a guaranteed return equivalent to the debt's interest rate. Employer match status? Is the 401k contribution at least at the level required to capture the full employer match? If not, this is the second priority after eliminating high-interest debt. The immediate guaranteed return on the matched dollars exceeds any other available investment. Tax-advantaged account status are the HSA, Roth IRA, and 401k being funded to their optimum levels given the investor's tax situation? If not, the tax optimization layer described in Chapter 7 is the next priority, generating meaningful after-tax return improvement without changing the investment strategy. Step 2. The strategy selection. Based on the financial foundation audit, the available capital, the investment, timeline, and the risk tolerance, the specific doubling strategy, or combination of strategies, is selected from the framework this video has described. For the investor with high-interest debt, debt avalanche is the primary doubling strategy, capturing the guaranteed return of debt elimination before investment diversification. For the investor with no high-interest debt, modest starting capital, under $25,000, and a long timeline, 15 or more years, index fund investing with maximum tax-advantaged account utilization as the primary strategy, with factor tilt for enhancement and complete avoidance of speculative strategies. For the investor with moderate starting capital, $25,000 to $100,000, a medium timeline, 10 to 15 years, and professional capacity, index fund core with rental property addition for the leverage and cash flow returns that accelerate the doubling timeline. For the investor with substantial starting capital, $100,000 or more, an entrepreneurial orientation and relevant operational skills, small business acquisition, or BRRRR real estate as the primary wealth doubling vehicle, with index fund investment as the base and the speculative tier sized at 5% to 10% of the portfolio. Step 3. The implementation sequence. Here is the specific implementation sequence that converts the selected strategy from a plan into an executing system. Week 1. Open the brokerage accounts. Vanguard, Fidelity, or Schwab for the primary investment accounts. A separate brokerage for any speculative tier positions. The HSA provider through the employer or independently through a provider like Lively or Fidelity. Complete the account applications, approximately 20 minutes per account online. Week 2. Establish the automatic contributions. Set the 401k contribution in the employer's payroll system to capture the full match, and, if the budget allows, beyond the match toward the annual maximum. Set automatic monthly transfers to the Roth IRA and HSA from the checking account timed for the day after paycheck arrival. Set the automatic investment within each account. The monthly contribution should automatically purchase the designated fund without requiring manual action. Week 3. Configure the emergency fund and opportunity fund. Move the emergency fund to the highest yield savings account available, currently 4% to 5% at online banks, and set the automatic replenishment transfer if the balance falls below the target. Establish the opportunity fund, 1 to 3 months of living expenses, in a separate savings account designated specifically for deployment during market declines of 20% or more. Week 4. Establish the monitoring and review schedule. Set quarterly calendar reminders for portfolio review, performance assessment, contribution rate assessment, any life changes that affect the strategy. Set annual calendar reminders for rebalancing, mechanical execution of the target allocation regardless of current market conditions, month 2 and beyond. Execute the real estate or business acquisition strategy if selected, attending to the specific steps described in Chapters 4 and 5 on the appropriate timeline for those more operationally complex approaches. Step 4. The milestone map. Here is the specific milestone map that makes the doubling progress concrete and trackable. The specific benchmarks that indicate the strategy is on track and the specific interventions that get it back on track if it deviates. Milestone 1, the emergency fund is fully funded at 3 to 6 months of essential expenses. This milestone eliminates the specific failure mode, forced liquidation of investments during emergencies, that most frequently derails early-stage wealth-building strategies. Milestone 2, all high-interest consumer debt is eliminated. This milestone eliminates the specific wealth destruction of interest payments on consumer balances and frees the monthly cash flow for investment. Milestone 3. the first $10,000 of invested capital. This milestone is harder to reach than every subsequent milestone will feel, and reaching it provides the specific motivational evidence that the strategy is working and will continue to work. Milestone 4, the first $100,000 of invested capital, the most celebrated milestone in the personal finance community because it represents the first point at which the compound return on the existing balance, $7,000 per year at 7%, is large enough to be meaningfully felt in the account growth. Milestone 5. The investment income exceeds the monthly contribution. This is the specific inflection point at which the portfolio transitions from being primarily contribution-driven to being primarily compound growth-driven. The monthly investment return exceeds the monthly contribution, meaning the portfolio is growing faster than the investor is adding to it. This milestone, once reached, makes every subsequent doubling faster than the previous one. Milestone 6. The portfolio generates income equal to monthly living expenses. The financial independence milestone, the point at which the 4% withdrawal rate on the portfolio balance covers the annual living expenses. This is the specific destination that all the doubling milestones have been building toward, the point where work is genuinely optional and the financial freedom that this video has been building toward is fully, completely achieved. Chapter 13. The one mistake that guarantees you never double anything. Here's the final chapter, the short one, the one that doesn't introduce a new strategy or a new mathematical framework or a new asset class to research and evaluate. The one that says the single most important thing this entire video has been circling without quite landing on directly, the specific mistake that, if made, renders every strategy in every previous chapter completely irrelevant. The mistake is not picking the wrong investment. It is not missing the right real estate deal. It is not failing to negotiate the salary increase. It is not choosing the index fund with the slightly higher expense ratio when a better option was available. The mistake is not starting. Not the dramatic, conscious decision to never invest or never build wealth. Nobody makes that decision explicitly. The mistake is the specific, quiet, endlessly renewable decision to start later, after the emergency fund is bigger, after the debt situation is clearer, after the market settles down, after the job situation stabilizes, after the children are older, after the tax situation is sorted out, after some specific future condition is met that will make starting feel more appropriate than it feels right now. This mistake has a specific financial cost that is calculable and genuinely alarming when calculated honestly. The compounding cost of waiting. The numbers that should keep you awake. Here's the specific financial cost of the 1-year delay in beginning the index fund doubling strategy, stated in dollar terms rather than in the abstract principle of lost compound growth that most people nod at and then ignore. The investor who starts at age 25 with $500 per month at 7% annual return reaches approximately $2,400,000 at age 65. The investor who starts at age 26, 1 year later, with identical contributions and identical returns, reaches approximately $2,230,000 at age 65. The 1-year delay costs $170,000 in final portfolio value, not from different behavior, not from different returns, from starting 1 year later. The investor who starts at age 35 instead of age 25, 10 years later, reaches approximately $1,190,000 at age 65 with the same $500 monthly contribution. The 10-year delay costs $1,210,000 in final portfolio value. More than half the final wealth is gone from the decision to wait 10 years. The investor who starts at age 45 instead of age 25 to 20 years later reaches approximately $520,000 at age 65. The 20-year delay costs $1,880,000, nearly 4 times the amount the delayed investor actually accumulates, gone from the decision to wait 2 decades. These are not abstract numbers. They are the specific, calculable financial consequence of the most common financial mistake available, the decision to begin later rather than now, applied to a single person's single wealth-building journey. Why the delay always feels justified. Here's the specific psychological mechanism that makes the delay feel reasonable at every moment it is being made. the mechanism that the investor at 25 and the investor at 35 and the investor at 45 all experience as a specific and legitimate reason why now is slightly wrong and soon will be better. The delay feels justified because the future starting point always comes with a specific resolution of the specific current obstacle that makes starting now feel impractical. The person with credit card debt imagines starting after the debt is cleared. The person in a transitional job situation imagines starting after the career is more settled. The person who doesn't fully understand investing yet imagines starting after sufficient research has produced sufficient confidence. The person overwhelmed by competing financial priorities imagines starting after the competing priorities have been addressed. Each of these obstacles is real. None of them are resolved by waiting. The credit card debt that prevents starting at 25 is still there at 28, often larger, because the absence of an investment habit means the absence of the savings discipline that would have addressed the debt. The career uncertainty at 30 is replaced by a different form of uncertainty at 35. The insufficient investment knowledge at 27 is not automatically resolved by 3 more years of meaning to learn about it. The future, starting point that will finally be free of the obstacles that make starting now feel wrong never arrives. It is perpetually replaced by new obstacles that feel equally legitimate and equally temporary. The starting point that is now, with the current imperfect financial situation, the current incomplete knowledge, the current unresolved obstacles, is the only starting point that actually exists. The imperfect start that beats the perfect plan. Here's the specific insight that converts the understanding of this mistake into the behavior that prevents it. The recognition that the imperfect start produces better outcomes than the perfect plan that is still being refined while the compound interest clock runs. The $50 per month invested today in the wrong fund with the slightly higher expense ratio compounds into more wealth than the perfectly researched, optimally allocated, ideally timed investment that begins 2 years from now. Not because $50 per month is impressive, not because the wrong fund is acceptable, because 2 years of compound growth on $50 per month, $1,200 plus the returns on the growing balance, exceeds the benefit of 2 years of research that produces a marginally better fund choice. The bar for starting is not perfection. The bar for starting is the minimum viable financial infrastructure, an account open, an amount designated, an automatic contribution running. Everything else, the optimization of the fund selection, the refinement of the asset allocation, the improvement of the savings rate, the addition of the real estate or business layer, can be improved after the starting has started. None of it can produce the compound growth that the delay prevented from accumulating. The only step that matters right now. Here's the only action this chapter is asking for. Not the complete implementation of every strategy in this video, not the optimization of the full portfolio architecture, not the negotiation of the salary or the acquisition of the rental property or the launch of the side business. One account, open today, any amount. Automatic contribution set. The Fidelity Zero Minimum account takes 15 minutes to open. The $50 automatic monthly transfer takes 5 minutes to configure. The total investment in the action that starts the compound growth clock is 20 minutes. The financial return on those 20 minutes, compounded over 40 years at historical average returns, is larger than almost any other 20-minute investment available. Every strategy in this video is available to you. Every doubling mechanism described across 12 chapters of specific analysis, honest timeline projections, and actionable step-by-step frameworks is accessible, implementable, and historically supported. All of them require one thing that this video cannot provide on your behalf: the decision to start today rather than to start soon. Soon is the most expensive word in personal finance. It costs $170,000 per year at the specific calculation above. It has been costing money since the moment you first thought about investing and decided to learn more before beginning. It will continue costing money for every subsequent day that it substitutes for the specific action of actually beginning. The chapter is finished. The account is waiting. Open it. Conclusion. Let's bring the complete picture into focus. You came to this video with a question: how do I double my money? And the answer has been delivered across 12 chapters with more specificity, more honesty, and more actionable detail than most financial content provides. Here's the synthesis. Doubling your money is genuinely possible. Not as a fantasy, not as a promise, but as a mathematical certainty, given sufficient time and the right strategy, or as a practical near-term outcome given the right combination of capital, skill, execution, and risk tolerance. The mechanism depends on your situation. For most people, with most capital levels, in most situations, the safest and most reliable doubling path is the index fund strategy combined with maximum tax-advantaged account utilization, a strategy that doubles money in 7 to 10 years with high historical reliability that is available to anyone with a brokerage account and 20 minutes to open it, and that requires no special knowledge, no market timing, and no expertise beyond the understanding of why it works. For investors with the capital, skills, and operational capacity for real estate or small business, the for-return structure of rental property and the cash flow premium of small business acquisition produce faster doubling timelines, 3 to 6 years under favorable conditions, with the specific operational requirements and execution risks that those strategies carry. For investors with the risk tolerance and appropriate position sizing for speculative strategies, the tiered portfolio framework that allocates 5% to 10% to high-risk positions, while maintaining 70% to 80% in the core portfolio, captures the upside of speculative approaches without creating the catastrophic downside that inappropriate concentration produces. The Rule of 72 is the mathematical foundation that makes all of this concrete, the specific tool that converts any return rate into a doubling timeline, and that makes the specific trade-offs between different strategies immediately visible. At 7%, you double in 10 years. At 15%, you double in 5. At 72%, you double in 1. The specific strategy you choose determines which of these timelines applies to your money. The behavioral layer is the determinant that converts the theoretical timeline into the actual outcome. The investor who stays invested through market declines, avoids performance chasing, maintains portfolio simplicity, and executes the pre-committed strategy through the periods when market conditions make it feel wrong will outperform the average investor by 2% to 4% per year, a compounding advantage that converts a 10-year doubling timeline into a 9-year one, then an 8-year one, over the full wealth-building career. The tax optimization layer is the free return, the specific practices that improve after-tax outcomes without changing the investment strategy, the risk level, or the capital committed. The 3 years saved by moving from a taxable to a tax-advantaged account cost nothing except the 20 minutes required to open the account. And the income side, the negotiated salary, the developed skill, the side income built and invested, is the multiplier that makes every other strategy more powerful by increasing the capital available for every strategy to compound. Here's the most honest final thing to say about doubling your money, the thing that this entire video has been building toward, and that the enthusiastic version of the same content consistently omits. The doubling is not the destination. The doubling is the mechanism. The destination is the specific freedom, the financial independence, the genuinely optional employment, the life organized around what matters most, that the accumulated double, and the double after that, eventually makes possible. The person who understands this, who is building toward the freedom rather than toward the number, makes better investment decisions, sustains the strategy through longer difficult periods, and arrives at the financial position that makes the freedom real with more speed and more certainty than the person who is chasing the number as an end in itself. Double the money. Use it to buy back the time. Use the time to build the life. That's the whole strategy. Everything in this video is the detail. The detail is worth knowing. The strategy is the thing. Go execute it.